which leads me to you, Rob, because you've done something that Malcolm has done of late. You looked at something that has gotten beaten up pretty good, and you said enough's enough. You bought ServiceNow. Tell me more.
And I don't think we're calling the bottom, but this is...
You're calling something.
This is a platform of we're saying that this is a platform of platforms. This sits atop the corporate IT stack, single control point over underlying tech. Think about it as the air traffic controllers for enterprises. 90% of the Fortune 500 companies use them. Dominant database management. The margins are still great, 35% free cash flow margins, no debt, conservative. We think we're buying it at a 50% discount to its long-term average. There's a margin of safety there that's reasonably attractive.
Malcolm,
welcome to the party.
Yeah. So what do you say to that?
Where were you 3 months ago when it was basically me and Bill McDermott making the case that this company is not going anywhere and the market is missing something?
There we go.
Yeah. Just coming back. Well, you also sold Adobe.
We did.
You just finally decided enough is enough.
The AI disruption is not enough, and this is
you and Farmer Jim need to have some kind of session, or so. He needs an intervention. He needs an intervention.
So I've completely done a 180, given that you start to see the power of these things in enterprise when you bring them in. I think the AI disruption questions need to outweigh the valuation at this point.
Now back to Malcolm. You bought Okta, so you're not done. You're not done looking for deals.
Yeah. So I think two separate things are happening right now. We were just talking about software and the way that it's gotten crushed because software doesn't sell the way that it used to. On a per-seat basis, just isn't going to cut it. We also have to consider that when a company sells off 30, 40, 50% in 6 months or less, who shows up? The activist investors. And what do they demand? A company puts itself up for sale. And so I think that a put is in some ways being put in under a lot of these companies that you do believe deliver a service that will be useful long term, in the sense that there will be tons of M&A transactions that have to happen because these companies have lost so much that someone shows up with deep enough pockets to take them over. So in Okta's case, I think that it's fallen enough. It's about 40% from its 52-week high. I think 75% or so from its all-time high that it hit way back in COVID. And this company basically is helping to make sure that agents don't run rogue, is what their new AI product is proposing to deliver. So we're talking about a world that's run by agents, and the term that I've heard recently from the cybersecurity world recently is agentic governance. It's basically who has access and what are they doing with the access. That's basically Okta's claim to fame. And so to me, this is a company that's been whacked down enough that it's de-risked enough that it makes sense to be buying it right here.
All right, so there's going to come a time where when we talk about software and we don't automatically pivot to private credit.
I knew you were coming.
Today's not the day. Today's not the day that we're going to make that move. Because we are going to, because we have no choice. They're just linked. Morningstar data, private credit fund inflows in the first 2 months of this year dropped by more than a third. Throw Barclays into the basket, though, that says this may get worse, it may look terrible, may be bad, but it's not systemic. Which brings me to Rob, who, as you may recall, I would say maybe was the biggest defender of private equity.
Still am.
Why'd you sell Blackstone?
So, tax loss. Fundamentals we don't think are deteriorating. We think it's dead money maybe for a little bit.
What's a little bit?
As this story plays out. Well, I'm going to tell you. We're selling it in our client portfolios, but I am considering personally buying it when my 30-day window's up after the tax loss back into my own portfolio. And the reason is because I think this is going to turn out to be that we are at the kind of crescendo of what's happening. Now, spreads are going to widen in private credit because they need to, because they're going to raise less money. The whole theme of democratizing investment, the mismatch of retail, immediate demand liquidity with longer duration investments will be an intermediate term issue. However, let's not forget that private equity mostly sits underneath all the credit that you have in this. That there are holidays in a lot of these loans, if they're leverage funds, that these guys can protect themselves with. So if things get too bad, there's liquidity holidays. I am not seeing massive issues in these portfolios, even in I'm drawing a blank on the name. the big loss that Jeffries had. First Brands. Even in that, the loss was 2% to Jeffries' portfolio.
But it's interesting, though, that you're selling this out of your client portfolios.
And mine right now, because I'm in the same portfolios.
Y'all are just tired of taking those phone calls from your clients saying, how much exposure do we have?
I can defend it till the cows come home. I promise you that. But there is a fundamental change in the growth trajectory of this space, because raising money from retail investors is going to be tough for a while. We are still seeing institutional investors. I don't care what these guys are doing. I could give two about it.
What are you talking about?
What do you mean? What am I talking about?
You beat me up for saying this sector has a sentiment problem. We have to sell out of it until the sentiment shifts. You defended it until the cows came home.
And I still
10
will.
straight minutes of you defending private credit.
I will still defend private credit.
While you sell it?
The issue I have
I'm
is
taking
that,
a tax
Hold on, I
loss.
want his response.
You needed to say.
I want
all
his
you needed
response,
to say
because this
was
is getting good.
What Malcolm
This is getting
said.
good. I'm going to get more comfortable over here.
All you had to say to the viewer is, see Malcolm's previous comments, I now agree. I've now woken up and realized Malcolm's
I didn't know you were the debater. I thought it was him and him.
I like where this is going.
It's been 2 weeks. What has changed in the 2 weeks since you beat me up about this?
I knew this was going to be the day. And I was ready for it.
And I listened to your case, but you're basically having it both ways, and I don't understand.
I'm having it both ways.
I'm listening to this and saying, what has changed since Malcolm looked directly into that camera and said, it's time to sell Blackstone?
Are you going to allow me to answer?
Heck no.
I mean, you're going to allow me to answer. So,
proceed, please.
We are making other changes in our portfolio. We need tax losses, and we don't have many. And so we are taking that as a tax loss, and I could be on here in a month buying these, and I could be buying the entire BDC basket in a month, because I know that many of these loans are good. There's a handful of loans, but I talk to the private equity community every day. You really think they're going to walk away from every loan and not put more equity in it?
No,
and private credit is damaged more than PE?
What you said is important. Arguably the biggest growth engine that this industry has had
is changed.
Is changed.
Maybe dramatically.
Vanished. Vanished for the next 1 to 3 years.
It's changed.
But listen to what he just said. What he just said was, do you think they're going to walk away and not put more equity in it? So if they've got to shore these up, right, and put more equity in it, then what's going to drive their growth, right? There won't be growth. They're just going to continue to backfill. So I don't get the buy case for it. You know, I don't see the catalyst to turn it around.
We got to take a
I like the instinct. These stocks are all down 40 and 50%. I like the instinct. I think what I would just say is, like, the fundraising environment in the second half of this year might be the worst they've ever seen.
I think that's right.
Since they've been public. And so now as an investor, you have to think about, all right, it's going to take 2 years for people to forget the gates and be interested in taking meetings about new allocations. And to Steve's point, it's like, all right, well, what are they going to spend the next 2 years doing? Making sure they don't blow up. That is not necessarily profitable in the short term. And so I like your instinct. I just think you're early.